The Fed just raised interest rates. Check out the Mortgage Minute next on how it's going to affect you. Hey, it's Ryan Skaggs, and this is the Mortgage Minute. Thank you so much for tuning in. This channel is dedicated to everything mortgage, real estate, and interest rates. We're going to dive in those interest rates. We had a really big jump on the average 30-year fix, according to Freddie Mac, week over week. Check out the link below. You can actually go to freddiemac.com/PMMS and be able to see that weekly survey. While you're down there, hit that like button, hit that subscribe, and click that bell icon to be notified as I'm putting out weekly videos on the channel. Now, what did the Fed do? On Wednesday of this past week, the Fed had their meeting minutes released, and then Chairman Powell of the Fed actually took questions. So what they had in their minutes, they raised the Fed funds rate. Basically what that means is they raised the amount that banks lend when they're lending to one another, and that basis is also on your credit cards, lines of credit, auto loans, things like that. Now, it is not a direct corollary to a 30-year fix, meaning that they didn't raise the 30-year fix from 4.5 to 4.75. They raised this Fed funds rate, which is based on these other, kind of product options. Now, what did it actually do, or how did it affect the mortgage market? Is we saw interest rates actually move up. So one of the things I think investors wanted to see was potentially that the Fed would actually raise rates even higher, because by them raising rates, that would hopefully cause inflation to go down. And if you've seen any headlines, inflation is going crazy. I'm sure if you've gone to the gas station, you have seen a more expensive gallon of gas than in past. So that is what the Fed is doing. Now, what is our trend going to be? I'm going to put a chart up here, and what I want you to look at is that over a 12 to 13 month period, back 4 years ago, we saw this same trend of constant upward trending interest rates. That was followed by a couple of years of leveling off and or going down in rates. So my hypothesis is that we are at that kind of breaking point as we speak. We're at the fork in the road. What are we going to see from here? Are we going to continue to see rates rise and we're going to buck that trend? Or are we going to see rates move down? This chart really shows you, from a weekly survey and over the period of 5 years, we saw that same 1.2 to 1.3% increase in rates over a 12 to 13 month period before, and then we saw rates move down. Now, it is a completely different market than we saw back 4 years ago. With that said, though, history tends to repeat itself. So in my take is that we're going to continue to see rates trend kind of parallel, meaning that we're going to see rates stabilize over the next few months, over the next 6 months. But the war with Ukraine and Russia is absolutely going to play an effect on it, and then inflation. So if we continue to see inflation rise, all bets are off. My hypothesis is broken. So that's what happened in the mortgage markets. If you have any questions, put your comments below. Thank you so much for tuning in, and we'll see each other again very, very soon.